Good afternoon, everybody, and welcome to Ask the Experts for Wednesday, 31st of March. My name is Carl Kaplingwa. I'm the market analyst over here at Think Markets, and it is a pleasure to be with you this morning as you take control of the conversation. We talk about the stocks that you want to discuss. We'll do that after we talk about the Think Markets difference, which is substantial. $8 flat rate trades, your own holder identification number, unlimited phone support, and of course, no hidden platform subscription fees. Four fantastic reasons why you should make sure your next ASX share trade is with Think Markets. The agenda today is pretty simple. Over to you. You ask about the stocks and I analyse them. So we'll open it up to the group, and we've got one coming in straight away on Appen. And the ticket code on that one is APX. And it is a stock I haven't followed for a little while, but I did follow it quite closely through this period here. It was doing very well, and the trend was fantastic. And then we had a bit of a consolidation phase, and I must admit I've lost touch with it a little. And the reason for the decline, and probably around about this exact bar here, was a disappointing earnings report where they said that COVID interruptions, so particularly in the US, COVID was making it difficult to access their clients and service their clients, and was also further to that, crimping some of the budget spend on their services. So these guys do artificial intelligence services, machine learning. They're some of the biggest clients. Some of the best known companies around the world are their biggest clients. So you've got the likes of Facebooks and Teslas and things like that. So a lot of their technology has been used in self-driving vehicles and analysing big data samples from us, consumers, customers, and then helping computers make decisions on what to do. So COVID has been a big problem for them. Part of the other reason why they've struggled recently is the rising interest rate situation. So whenever interest rates are on the rise, it tends to hurt stocks with longer durations than stocks with shorter durations. And a long duration stock is a stock whose tends to be high growth. Often these are technology names, and their earnings are a ways down the track. And when interest rates go up, the rate that we discount those earnings back to a present value also goes up, and therefore those earnings further out in the future are worth less now because of the time value of money. So some of the reasons why Appen hasn't done very well. In terms of the outlook, well, we are at the cusp, potentially, of a significant reopening, particularly in the US. You would expect some of those budgets and some of those customers are going to return to normal, and hopefully, fingers crossed for Appen. We don't like to say that in markets, but that should see their current half and beyond comparisons look a little better. I think the question will come down to valuation, and I'll get some numbers for you on that in a second. Just waiting for some technology items to catch up here to me this morning. The chart doesn't look fantastic, unfortunately, while I'm waiting for these fundamental items to catch up to me. Just give me 1 second. Figure out why this isn't working. And click on that, and that should come up. Okay, so short-term downtrend is very well established. That's the light pink zone. So this is our shorter-term moving averages, and you can see that when the price hits this level, it tends to not spend very long there before it tends to come down again, and that's what we've seen quite consistently. So I wouldn't be a buyer until we can at least get above this pink zone. Now that pink zone is going to continue to fall along with the price, and the earliest that might happen is a move back up through sort of the high 17s, potentially even into the $18 zone. Now, even if it does get above that, it's then got to deal with this long-term downtrend zone, which is in place now. That'll probably come in around that 22 area. So plenty of things need to happen before we can consider buying Appen, and I didn't mean to rhyme that one. The other thing is that we'd like to see some white candles coming in, so a little bit like what we saw here, but that's not all that inspiring. You can see they petered out very quickly and turned into black candles. Maybe something more like what we saw back in the pandemic low there. So you can see the size of these white candles. Yeah, there was a little bit of a pullback, but then the white candles popped in again, and we made a constructive double bottom low here with higher lows. This looks like it's still very, very weak to me. Okay, so long story short, buy, hold or sell. If I had it, I'd be very concerned. I think there are potentially lower prices ahead. If I didn't have it, I certainly wouldn't be buying it for all the reasons that I just discussed. So thanks, Nicholas, for bringing that one up. The next one that's come through is SYA, and there's a question about there's a bit of capital raising on this one, and the question is where might it go after the capital raising? Okay, so we'll go into SYA, and heading down the list, I do like to look at these. Sorry, not that one, more this one here, and this one here, which doesn't exist because there are no dividends for the stock. But we're looking potentially at revenues, which are very, very small. So that's an order of magnitude of $60,000 a year. And when you see revenues that small, it is nothing more than interest on money held in the bank. And then, of course, we've got net profits, which are falling, getting worse, down to 5 billion. Issue of securities. What I'm looking for here is a 4C, half-yearly accounts. So we're looking for quarterly activities, quarterly cash flow report. Okay, so they're burning through $1.4 million a quarter, and they had at the end of the last quarter $4.5 million in the bank. So doing the maths, that gives them 3 quarters of a year, and that's why they had to raise money. In terms of receipts from customers, we've got 000. So look, I'll cut this one very short. It's one of those stocks that unless they find something, they're never going to be anything. In terms of that, they're the fundamentals. In terms of the chart doesn't look awful. There are some trends here. I would suggest, though, that with this formation and this formation, that until we get back above this price level here, I would just be waiting and watching, and that high is 4.3. So unless you saw 4.4 cents, I would not be involved in this stock. I can't see a lot going on for that one, Bippen. The next one is PDN. So just trying to give you an idea of how you can find the information for yourself. This needs to be practical as well. It's one thing to do the analysis for you, but it's another thing to show you how to find that information and do the analysis yourself. Okay, Paladin. So this one here, and I might see... So we're kind of in this realm of stocks that, unlike Appen, which does make money and have profits, we're in the realm of companies that really don't make any money. These are small mining businesses. They burn through a lot of cash. They get to the point where they don't have any cash left, and then they have to raise more cash from shareholders. So we kind of saying in the industry that rather than actually mining minerals, they tend to mine shareholders' wallets and destroy a lot of wealth along the way. So just confirming here on another screen, Paladin doesn't make any money at this stage, didn't have any revenue last year, but did have some revenue the year before. So this is a uranium miner. The chart does look pretty good, but I would be concerned about this pattern here. So when we are moving in a nice trend and holding this light green zone, so you can see here how we bounced back off that zone. Happy days, happy to stick with the stock. Once we start to break below that short-term trend, and with the candles that we see as of today are quite bearish, and we're seeing this lower pattern coming in, so I would suggest that this is an area of building supply, and that is a concern. I'll give you a level that if it breaks below, and that low there is 36.5. I would say if it starts to trade sort of 36 and 35 and lower, then there's a pretty good chance that it's going to come back into this area here around that 30 to 28 level, which is where that long-term trend is going to be. So we're going from sort of this area here where everything's looking quite rosy, to this area here where that short-term trend is very much under pressure, and I'd be very concerned if I had the shares right now if I was a holder. If I didn't have the stock and I was considering whether to put some money into this, I would say no, based upon those technicals. Based upon the fundamentals, there aren't any at this stage. The company doesn't make any money, so I can't give you a view on their fundamentals. As for whether they're going to find more uranium, you'll have to go read the statements on that one. Okay, we've got a few others coming through here. So A2 milk. This one's pretty easy. Obviously, we know what this one does. It's the baby formulas. China's a big market for them. In addition to that, the ability for movement of people between China and Australia is actually very important for them because it facilitates what we call the Daigou sales channel. And that is where Chinese nationals will purchase baby formula here and then send that formula back into China to sell at a premium and then make money. Without those sales, obviously A2 milk is suffering and continues to do so. If you think there's going to be a travel window with China anytime soon, then that may alleviate some of the problems. I don't think that's going to happen, at least for the next 12 months and maybe beyond. But it'll come down to vaccinations and vaccination certificates and the like, and then new strains and all of those unknowns. So A2 milk's clearly suffering as a result of that. Are there buyers out there? Are there big fund managers right now that have done the deep research on this and have said, you know what, A2 milk is way too cheap here and we're going to start buying? And looking at the chart, I can't see that. I can't see where the big fund managers are coming in to buy this stock at this stage. If anything, on any rally that occurs, they're actually looking to sell this stock. So I think we need to think like a fund manager. We need to trade like a fund manager. And if the fund managers are using any rally opportunity as a reason to sell, then that is very, very concerning for me. We will know that there is a potential bottom because we're going to see a bunch of white candles pop in to tell us that the demand has arrived, and it's just not on the screen right now. Now, I could be wrong, and today could be the lowest price it achieves in this downswing, and it goes up and up and up from here. That is an absolute possibility, but it's a very low probability. And even if today is the low point, we have to see those white candles come in. We can't go up without the white candles. Until I see it break through this downtrend here, it's a bit like Appen. It's a pass for me. If I had it, I'd be very concerned because I think lower prices are in store. If I didn't have it, I was considering whether to put my hard-earned money at work in the market on this stock. I'd say no, for me anyway. Kogan is the next one. And we'll see if this thing has caught up to me. I think it has. And we'll have a look at some fundamentals, catch up a little bit here on Appen. And we'll let that go while we do the next one, which is Kogan. Now, Kogan is looking pretty similar to Appen, and the last one, which was A2 milk, of course, and just copy and paste all of my comments for those. I think when this one does find its low base, and what will that low base look like? It'll look something like this. Okay, you'll start to see these large white candles appear. They'll appear with a sort of common low point. Okay, we won't break below that low point. In fact, we'll start to break below, defined resistance points in the market, as we can see here. We'll go from this clear-cut lower peaks, lower troughs phase to making higher peaks and higher troughs. Okay, so you'll see this transition. You'll start to see the price interact with the short-term moving average. It'll probably be resisted initially, but then it'll get above it. And rather than being resisted by it, it'll be supported by it. And the candles will continue to turn white and will continue to have high peaks and troughs. And then we'll interact with the long-term trend. Okay, so this is what we want to see happen in Appen. We want to see this happen in A2 milk. And we want to see this happen in Kogan before we start to get excited by this. Everything indicates a further move to the downside for now. And for that reason, if I had it, I'd be really concerned. If I didn't have it, I wouldn't be buying it right now. Let's check up on those Appen fundamentals. And this is Thomson Reuters data, so anything from FY21 is predicted data by these brokers here, so the brokers that are providing these recommendations. But it does have some support out there. You can see there are 3 strong buys on Appen right now. There are 3 buys, 6 holds, just the one sell. The average target is $21, so that's providing significant upside for Appen. And they are still expecting revenue growth into the future. The only problem might be for this one is this line here, which is the price to earnings ratio. So even though revenues and earnings are expected to grow, the stock is still, quote unquote, too expensive for the revenues and the growth that it's going to have. And that's a function potentially of it going up too much in the first place. Okay, so a lot of these tech stocks, as I said at the start of this presentation, are being impacted by these higher rates, and investors aren't prepared to pay as high multiples as they were in the past. So in the past, where they were able to sustain something, in 80s and the 50s in terms of their multiples, that's just not happening right now. So that is the problem for Appen at the moment. So we can have a look at, very quickly, the one for A2 Milk. And that takes a minute or so just to load up, so we'll keep moving with some of these stocks, and then we'll look at Kogan. The next one is PME, which is Medicus. This one doesn't look so bad because, unlike A2 Milk, unlike Kogan, unlike Appen, hey, it's still in a long-term uptrend, but it is impacting negatively with that short-term trend. It's starting to break below that trend. We talked about it on Paladin. So this idea that once we start to make these lower peaks and lower troughs, we come back up, we can't hold that short-term trend, and then we break below. It's quite bearish in the short term. In the long term, though, the trend is still up, and we could see something similar to this, where we come into this zone. Okay, so yeah, look, I'm certainly not a buyer of PME at this stage, but all is not lost in terms of the trend. You would be looking for those white candles to appear in here, those higher peaks and higher troughs to appear in here, and then you could be looking to get back in. It might be around 38.50, but at least it's about $10 cheaper than paying top dollar up here if you're looking to buy it. If you had it, well, I think I've given you a pretty clear roadmap of where it might be going, at least in the short term. Let's quickly get back to the A2 Milk fundamentals, and we're looking here. Revenue is expected to fall certainly this year, pick up a little bit next year, and then get back to sort of pre-COVID levels in FY23. In terms of its valuation, though, it's still pretty high, in the high 20s, and I think that was also part of the problem. So for Appen, A2 Milk, they're companies that got ahead of themselves in terms of their valuations. They probably shouldn't have gone up as much as they did. And when things are rosy in the economy, you can support those high valuations. When interest rates are low, when the pandemic hits, when interest rates go up, the appetite for paying such high multiples diminishes, and we can see share prices halve for no other reason, but they just doubled for no reason in the first place. So I can't see anything in the Appen fundamentals or the A2 Milk fundamentals to suggest to me that the stocks are ridiculously cheap right now. We should be running out to buy them. Let's have a look at Kogan while we're here. KGN. We'll let that load up, and we'll move on to the next one. We've got ALU, another one of those big technology stocks. Unfortunately, looks pretty similar to Appen. We sound a bit like a broken record here, aren't we? There are some positive signs coming in. This doesn't look as bad as a couple of the other ones. Certainly, it is still being resisted by the short-term zone, and you can see how important these zones are. You can see prices get to that zone, and then it's like, I don't want to say magic or gravity or whatever you want to call it. They just hit that zone and just come straight back down again, and that's where we are now. So the short-term trend clearly down. I can't see any reason why that would change anytime soon. The long-term trend has switched to down as well. There's a fair bit of support that will likely come in this area here, around that sort of 23 to 24 zone, because that's where the low from March last year was. And I'm going to say the same thing again. Unless we see this sort of a pattern with the white candles coming in, the higher trough being set, the interaction and then conquering of that short-term downtrend, it all will probably happen in and around this zone. I can't call it a buy. There is a little bit of hope here because we have seen a bit of demand come in around this area here. And maybe let's just do the circle there, because these lower shadows tell you that there's demand. So the price was very, very low in the day. The demand came in, pushed the price back up to the close. So 1, 2, 3, 4 of them. There's some demand in and around this level. Okay, if we can hold that level and push higher again, that would be constructive. So something like this. Unfortunately, however, if we break that level, then there's a very, very high probability we're heading into the 23s and 24s. So I don't have any good news for you either on Altium. This is a bit depressing, I think, this session today. Let's have a look at the numbers for Kogan. So we have had some good growth come through, over the last 3 or 4 years, and we're expecting that growth to continue. So some great growth to come through in terms of the revenues, in terms of the earnings as well. EPS numbers. It all looks really, really impressive actually from here. Dividends are expected to increase. So the Kogan fundamentals look very strong. The brokers are pretty positive on it as well. One a strong buy, 2 buys, just the one hold. The mean target is 20.71. In terms of the valuation, well, this is it's still relatively high compared to where we'd like it to be, sort of sub 20, but it does come down very quickly. So I think in terms of the fundamentals, Kogan is the closest one to actually being at good value right now. And this PEG is amazing. So Kogan would be, out of all the ones we've discussed today, as prospective turnaround plays, and this is notwithstanding the technicals, of course, from a fundamental basis, I think Kogan is the one that's the cheapest stock. So Altium, A2 Milk, Appen, they're all very similar charts, but Kogan is the cheapest of the lot. Now, where is it going to be a bargain? Well, we have to wait for the chart to tell us that. It could be $10 and it could be even cheaper. But that's the one I'd keep an eye on if you're looking to find a bargain. Okay, so Bipin's found some numbers there on SYA. It's hard to look at these just off the cuff like this, and he said it is at 3.2 cents. Okay, well, that is helpful. I'm not sure what that 0.8 of a cent was all about then, Bipin, but if it is at 3.2, at least it's not such a severe discount to where the market is. Whether it's a rights issue. Whether that the problem is that when that stock comes on, it does create more supply in the market. And it just comes down to what they're going to do with it as well, Bipin. I don't know this one well enough. I don't know what they're actually trying to do to make any educated comment on whether it's prospective. No idea what happened here, honestly, but the chart would suggest that until we get back above that level there, which is 4.3, 4.4, I don't think there's any rush to do anything with it. So if you've got it, hold it. It's a few of them I've said I think they probably will keep going down. This one, it's hard to say. It's still holding the short-term uptrend. It's still holding the long-term uptrend. I don't like the fact that these peaks are forming at a lower point, but it's worth holding if you had it. I wouldn't buy it if I didn't, though. CSL from Jackie, let's have a quick look at that one. How are we going on time? We're getting pretty close. Probably just do this one and then VUK and Lynas, and then we'll finish it there. So CSL, we're starting to see these. Well, hopefully you're starting to be able to look at these charts and do this analysis for yourself. So we've got the short-term downtrend. We've got the long-term downtrend. That's not a great start. We are interacting with the short-term zone and we're above it. That's a slight positive. We'd really want to see a tick up from here. So for CSL, we've talked many times this morning about, or this afternoon, your time, about interacting with the short-term trend and getting back above it and then starting to put in this sort of a pattern here. Okay, and if CSL can do that, I'm going to start to become more positive on it. I wouldn't exactly necessarily say, even if I was more positive on it, it'd be the one I'd run out and buy right now, because overall, it just appears to be really, really struggling. It just doesn't look like things are easy for CSL right now. So it's if you had it, you might hold it on the basis that there is some positive signs here on this short-term uptrend. The recent candles don't look good, but you might hold it on that basis. If you didn't have it, it's not one I would run out and buy right now. I just can't see any reason for it. And part of that reason is D3 here. We might quickly go to CSL and then come back and have a look at Medicus and Altium on the fundamentals. Takes a minute to load there. I'll come back to CSL. VUK, Virgin Money, finally a stock that's in an uptrend and hasn't broken that short-term uptrend. So these are more the sorts of charts I like to look at for everybody that's attending today. I like to see green on the short-term trend, green on the long-term trend, even if we're at the start of the trend, so sort of down here. I'm not saying you have to buy things that are always up the top of the range, even if they're just sort of in this area here where we have broken above those long-term trends. Those long-term trends have gone from offering previous resistance to now starting to offer support and providing bases from which we can launch higher from. So this is more like what I'd like to find. Drilling down on the shorter term price action, well, we're still holding above this short-term uptrend zone, so that's constructive. There aren't any clear double top, lower top patterns that we saw in a few of those other stocks that were in uptrends. So this one still looks fine to me. If I had it, I would absolutely hold it. If I didn't have it, I would consider buying it. I think you could actually take a little bit of a punt here and buy it with a very tight stop loss. So if it broke back below 320, you'd be saying, well, I've lost 25 cents there, and I'm going to take a 25-cent loss and get out. But if it holds the trend, there is some resistance there at 375, but maybe 415 is the longer term target. So work out, your risk reward there. Maybe it's sort of 2 or 3 to 1. It's fairly good in that regard. So it's one of the better ones certainly we've seen today. Let's quickly get back to CSL. The brokers, I can't really understand it, but they still seem to be very supportive of this one. This is the big problem for me. I'll cut a long story short. It is way too expensive. And without the growth to justify it, so this number here should be 1 or less. It's at 5. It's way too high. And the PE is too high. So without the growth to justify its current valuation, CSL is too high. I think CSL could quite literally halve in value before it became cheap in my eyes. So I'm not a fan of CSL, but that's just my own personal opinion. I think the chart's largely reflecting that too, though. Altium, very quickly, and then Medicus. We've got one more to do on the chart, and that's Lynas. So apologies if you've got other ones you want to look at. Save it till our next session. Lynas looks pretty good. It did have a little bit of a nervous point here, and this is where I was talking about, where you see those black candles come in at lower points. But it's come back pretty well from that. The question mark for me will be what it does in this area here. So if we see this third sell-off, that would be a little bit concerning. But if we can sort of hold and build a base around here, then that would be fairly constructive. The short-term trend is up, the long-term trend is up. So on that basis, if I had it, I would hold it on the basis of this very strong, 1, 2, 3, 4, 5 days. It's certainly worth a hold. If you didn't have it, would I buy it right now? I don't think so. I think I want to see a little bit more evidence that this pattern here is being negated by demand. So this pattern here was more about supply than demand. If I saw even just a little bit of a pullback here, and then we started to make this sort of a formation, so we've gone from lower peaks through here to starting to make higher troughs, high peaks. That would be when I'd become more confident that any supply in here is temporary and that we're heading back up again. So it's certainly a hold for me. To buy it, I'd need to see a little bit more evidence. Let's have a look quickly at Altium, and I'm going to get quickly down to this line here. And this is the problem for all of these technology stocks, everyone, is their high valuations. They're crazy high valuations, and there's not enough growth now in some of these because of the COVID impact to justify those valuations. On the way up, it was fine. But when things turn, they can get pretty ugly. So really, we want to see a stock around about 20. And even historically, 20 is quite high. You want to see stock around 15 is fair value, 10 is cheap. This is at 60. So that tells you that this stock could divide by 4 before it's anything that resembles value. So the share price could be a quarter of what it is before we see value. And at the mind, sometimes it's hard for the mind to get around that oh geez, my stock could be a quarter of its current value before it's cheap, because we get so anchored to prices going up, we don't realise that things can halve and quarter again, because we haven't been around long enough, unfortunately, and we weren't there in the dot-com boom when things did exactly that, where multiples got stretched way beyond what they should have been, and stocks ended up losing 90% of their value before they came back to anything that resembled fair value. That's potentially a long way to go. A quarter of that would bring it back to sort of here, and then you'd say, well, that Altium's looking really cheap right now. Okay, I'm sorry if I've scared anybody out there, but the charts are pretty consistent, I think, with some of these assessments. Let's go D3 and PME. I think the message is prevention rather than panic. So if you're starting to see, if you're starting to see the short-term trends being pressured, and then the long-term trends being broken, why are you hanging around? Why are you hanging around? This long-term trend was broken back here when the stock was $34. The charts are telling us what the market thinks about our stock. So who cares what we think, right? We don't make the market. I think we're done there on that somber note. Hopefully I haven't scared you too much. We'll go back to the slides and we'll do the usual disclaimer stuff, because that just allows me to finish my presentation. There it is. Okay, thanks for joining me today, everybody. You can catch all of our market updates at the market news section of the website. So news, views, analysis, and opinion. You can follow me or the Think Markets handles there on Twitter. The upcoming events, these are all webinars. So you're here because you registered for a webinar. So I know you know how to do this. If you're watching the recording, you do need to get to the webinars page and participate. Get involved in the conversation. We have just ticked off Ask the Experts, of course, on the 31st of March, and the next webinar we'll be having is one of our 3 series where we analyse 3 interesting stocks or sectors, and we'll be doing 3 ASX turnaround stocks, so stocks that have been beaten down. Could it be Altium? Could it be Appen? Could it be A2 Milk? I doubt it, based upon what the analysis was today, but we're going to try and find stocks that are showing signs of turning around. Then the next Ask the Experts is back on the 28th of April. I know that seems like a bit of a break, but I do have some leave coming up. And then we'll be doing a fundamental analysis refresher, where I will take a bunch of case studies in the market, and we'll actually go and find all the information we need to find on those stocks, and then do some fundamental analysis on them. The disclaimer before I leave you says that everything we discussed today was general in nature. You do need to consider all of these things and then make your own mind up as to what you're going to do. We are a regulated broker. We do have some products that could see you lose more than your deposit. So please read this disclaimer carefully, or give us a call if you have any questions at all. It has been a pleasure chatting with you this morning or afternoon, depending on where you are. All the best for your trading until we catch up again. Bye-bye for now.